Hi, it's Larry Gaines from Options on the Open. We have been very focused on oil and other commodities for a number of reasons, which most of you probably already know. But for the past several weeks, oil has really been front and center. My trading background is in oil, and I've been part of the oil trading industry for over 25 years. I feel very comfortable with the macro ins and outs of the oil markets, and this is a major benefit to our members at Options on the Open. I like to follow the oil macro fundamentals and then select certain energy stocks to trade using our trading model to help us identify the best stocks and the best entry points. To really trade the oil markets, you need to be able to trade the oil futures contracts such as the NYMEX WTI futures contract and the ICE Brent futures contract. These two contracts are used as the benchmark for pricing most grades of oil traded globally. You name the grade of oil and its price is probably tied to one of these two benchmarks. But trading these contracts can be very challenging if you have no prior experience. So how can you take advantage of the pure oil trade without trading the futures? Well, there are a couple stocks that are highly correlated to the movement in oil and are a better way of trading oil than using the oil ETF known as the USO. The USO ETF has some major fundamental flaws, and it is not one that I would recommend. You see, the USO is made up of WTI futures contracts, and unless you can take physical delivery, like a refiner, you have to exit your position before expiration, which can put pressure on the pricing of this ETF. So it might not be representative of the future oil value or pricing curve out in the future of oil. For this reason, I found some other ways to trade oil using stocks and ETFs that correlate nicely to the price of oil futures or the oil future markets. This video will compare a few of these stocks to the NYMEX WTI futures continuation contract and the actual prompt month April futures contract, so you can see these correlations. And I hope this will help you in your trading. So let me show you a couple of these charts. Now the first chart is the monthly crude oil continuation contract right here, this upper chart. So each bar here is 1 month period. And this is a crude oil continuation chart. The chart below is the ETF USO, and this again is the monthly. So if you compare these two, using the actual, this is actual futures, NYMEX futures WTI continuation chart, to the USO, you can see the correlation here. You know, as the market shot up, this is July of 2008, where we reached, the real extreme highs of the pricing market for oil. As you can see, this shot up here, so did the USO, and then markets came down and went flat. So it looks like it correlates, but when you look into it a little bit further, using the actual prompt month April contract, you will see the difference in what I was talking about. So hold on, let me put that contract up. Okay, now here we are. This is the actual April 2011 futures contract for crude oil, NYMEX WTI. This is the current prompt month crude contract being traded now. And here is your USO ETF, and this is the monthly. And you can see that the actual price of the prompt month crude oil has substantially more of a gain than this flat pricing of the USO. So you can see here that the correlation actually does break down, because the front month contract, you can see, is a steeper value than the USO, which is remaining flat. Now this chart is the same. We've got the monthly chart of the crude continuation WTI, and then below it we have Apache oil, APA. Now you can see that in 08, as oil reached its peak, Apache shot up here and was also trading at its highs, and then it came back down, and basically is pretty in sync with the continuation chart of WTI. So it does correlate, so it is one that we will use quite often. Now I'm going to pull up the chart of it, comparing it to the April prompt month, and you can see the difference there between it and the USO. Hold on. Now on this chart, again, this is the April prompt month. This is the April contract, not the continuation. This is the actual April contract for NYMEX WTI, and here's the Apache oil below. So you can see the correlation here. It really correlates better with the actual futures price than USO did, which was going flat to sideways. So this is Apache, and this is one that we will use quite often, and I think this kind of really shows you a vivid picture of how it does follow oil. Now the next chart I'll show you will be using the ETF XLE. Now here's the again the continuation chart for WTI on the NYMEX futures contract, and below it I put the XLE, which is an ETF that is made up of several of the major oil companies. It's made of ExxonMobil, Chevron, Schlumberger, ConocoPhillips, Oxy, Apache, Halliburton. These are some of the big cap names that are involved in this ETF. And you can see the correlation here. It tracks fairly well with the oil futures market. And here you can see it's got a steep move up here on the late rally that we've had in crude. And you'll see this more defined when I pull up the April prompt month contract. So let me do that now. Okay, here's the monthly for the April prompt month WTI NYMEX crude oil contract, and here's the XLE ETF on a monthly. So you can see it has a very, very nice correlation to the futures contract. So these are just a couple. There are several others that we trade, but I wanted to point these out that this is a great way if you want to trade oil and you can't trade the futures. This is another way for you to participate in the market. If you'd like to learn how to trade some of the other commodity markets, such as the ag commodities and materials using highly correlated stocks, please come join us at optionsontheopen.com, and look forward to having you. And again, thank you for your time.